Hello everyone, welcome to today's Markets Insight webinar presented by PurePrem. So before we start our session today, allow me to read out the disclaimer for today. Today's Market Insight webinar is intended for educational and informational purpose only, and participants shall not take it as financial or investment advice nor a trading signal. The accuracy and reliability of the information provided cannot be guaranteed. PurePrem and I hosting the session are not liable for any losses or damages resulting from the use of the information presented. Participants are not responsible for independently verifying information and considering their own financial goal and risk tolerance. Okay, this is the disclaimer for today's event. So as you can see for today, we know that there's a lot of economic data is going to present on Thursday and Friday. So what we try to do here is to prepare ourselves so that when the economic data disclose, we can actually prepare ourselves and then predict the trend for the price movement or for several asset class. And these are the topics that we're going to cover today, namely the Federal Reserve and the dollar index. And we all know that the dollar actually have an impact more than 80% for the entire forex market. So definitely the Federal Reserve and the dollar index is very important, and then we want to know more about it. And moving on, we will discuss the Eurozones and UK economic data. And then, of course, we will also try to discuss the impact on the euro and pound sterling, respectively. And the third one, we will discuss on the oil. And so we try to discuss the futures price movement for the oil prices. And lastly, RBA. Why is it important? Is because Australia is going to release a piece of economic data early tomorrow. And then just a reminder on the RBA, the Reserve Bank of Australia, they will announce their interest rate decision on the coming Monday. So this is also very important. We want to seize the chance. We want to trade and make profit. Okay, without further ado, let's proceed. First of all, is the economic data. For here is specifically for the US and also the relationship to the dollar index. We all know that Federal Reserve is the central bank for US. So we have to watch closely for their monetary policy because they have a direct impact on the dollar. That's why it is a matter to us a lot. So before we dive into the previous economic data and also the upcoming economic data, we will have briefly updates with you guys on what happened. So last week, we all know the Federal Reserve actually announced their interest rate decisions, and yes, it came as the market expected with 0 BPS hike. So it means that the Federal Reserve decided to post their rate hike, and then yes, of course, the market predicted that they might have another one that's going to come in November or December. But then it is not the case at the moment. The current interest rate level is still standing at 5.25% to 5.5%. But nevertheless, if you always keep a close eye on the markets, you can tell the dollar index, DXY, is still gaining. And in fact, it's still gaining at the moment. Why is it so? Maybe we'll discuss it later. Okay, moving on. Last week also have a crucial piece of data, which is the CPI. The US CPI actually increased to 3.7% from the previous reading of 3.2%. This means that despite the Federal Reserve able to tame their inflation from above 8% since early of the year, and slowly it gradually come down to 3.2% 2 months ago. But then here we come, there's a sign that the inflation have a slight increase, mainly perhaps due to the increase in the energy cost. We all know that the oil price has been superb. Since July, it started from below $70 per barrel for the WTI crude oil, and it is up to above $90 per barrel at the moment. And we're also aware that the Federal Reserve has their targeted inflation rate, which is 2%. So currently the CPI stands at 3.7%, which is still, a distance away from 2%. So we're sure that the Federal Reserve might do something, given that they have a relatively healthy economic as you compare to other major economy, namely the UK, the Eurozone, and of course China. So we'll try to decode what's the Federal Reserve they say last week, and then from there maybe we can make some predictions on their monetary policy outlook. That in the near future, and also we will anticipate for the upcoming economic data of the US. So in the FOMC press conference, we know that Jerome Powell and also other Federal Reserve officials, they actually signal for one more rate hike this year. And also the Federal Reserve is trying to orchestrate a soft landing. So what is a soft landing is, we know that if the central bank of a country, they increase the interest rate sharply, it will harm the economy. So it's is discouraging the economic activity. So when this happens, it might lead the markets into a recession. So the Federal Reserve is trying to avoid that. So what they want to do is to tame the inflation, at the same time avoid from getting into a recession. So far we can see that the Federal Reserve can be considered quite successful in engineer a soft landing for the US economy, because we can see from the past reading, the economic data from the US indicates that the US economy is still in a healthy status, where the inflation in the US also gradually coming down. Moving on, also we are aware that the US labor market still remain tight. This means that the economy is healthy. People are actually hiring. So the economic activity in the US, is still not have a very bad impact, despite the Federal Reserve have a very aggressive monetary policy, monetary tightening policy since last March. And and yes, remember just now we say that the current interest rate in the US is 5.25 to 5.5. So the market participant is expecting the interest rate will go to at least 5.6% this year or higher. But also bear in mind, there's a news that came out this week, which is they talk about this news is from the CEO of JP Morgan, Jamie Dimon. He says that this is what he said in an interview from the Times in India. So he actually predicted that the Fed rates might go as high as 7%. So this is also one factor that leads to the dollar further strengthening today. This news came, I think, 2 days ago, and we know that JP Morgan is one of the prominent bank in the US, and he is like a senior management. So maybe he has an insider, we do not know. Yeah, but then he wants the markets to prepare ourselves to welcome Fed rates that go as high as 7%. That's why, yep. At the same time, it also badly impacted the equity markets. So we know that the Dow Jones, Nasdaq, and also S&P is declining. whereas the dollar is actually climbing to a higher level that we not seen since last December. So we can have a glance of the economic data from the US. So previously, you can see that if you give a glance of the US economic data, you can see overall the US is staying in a relatively healthy economic status. But then the recent ones, you can see the building permit is came weaker than the market expected, and also the CB consumer confidence also declined than the previous reading, as well as came lower than the market expectation. And moving on, the new home sales also worse than the previous reading, as well as lower than the market expectation. But nevertheless, if you look at the dollar index is still climbing, and then it came to the highest level since December, last December. This from the slide shows that despite we have a slight no worse than expected economic data from the US, but the dollar is continue rising. And another big factor to bolster the dollar strength is because we know that the US government might have the risk to shut down temporarily because the government spending bill is not passed in the Congress. And then there's a time's up for them to actually get the bill passed by 30th of September. So we are now near to the dates already. That's why we can see now the dollar as a safe haven asset is continue to climb. You can see also why now the dollar is actually is a more favorite asset than holding the other safe haven assets like gold and also the Japanese yen. Is one of the reason is because if you hold a dollar, you actually can get a return, because like we say just now, the Fed rate is up to 5.25% to 5.5%. So when you hold a dollar and you put your dollar in the US bank, you can actually generate the returns of more than 5%, and then rather you hold the gold and also the Japanese yen, where you generate basically nothing. So when you have a very strong dollar in an inverse relationship, it will lead to a further decline in the gold price. So by just technically wise, we have a strong support level at nearly at 1885.5, about this range. But we can see from here now the gold actually trading in a very strong bearish momentum and is approaching to this support level. So if you now currently holding short positions, congrats you. But then if you didn't hold any short position, there's a two scenario for you. It's either when the gold price reaches this level, you can maybe try to catch a technical rebound from here. Yep, it's possible. And if not, maybe you can wait for another round, maybe when the gold price rebounded and then reaches here. And from here, we can catch another short position. Yeah, we can catch another short position from here and then continue downwards. So this is technical wise, wise for you, because in overall, you can see that the gold price is actually trading in a very bearish momentum, where now even the RSI is deeply broke into the oversold zone, where the MACD continue to have a lower low for MACD. This also from the side depicts that the bearish momentum for the gold is extremely strong at the moment. So these are the two changes that you might want to seize. The first one is when it touches here, catch a short technical rebound. or unless it broke here straight away strongly, and then maybe you can set a sell stop and continue the short position for the gold. Yep, and then moving on for the dollar, at the moment, I would say sky is the limit. We still don't know yet where the dollar will stop, because because now the market has this theme. We all know that the Fed have signals that they will have a higher interest rate for a longer period. So we can expect that this high level, above 5.5% of interest rate, might hold through 2024. I mean, through 2023, and at least will hold until the first quarter of 2024. That's why at the moment, even the US Treasury yield is up to the highest levels in decades. So, yep, the dollar will be very, very strong. And moving on, we will discuss the economic data from the Eurozone as well as the UK. And from there, we will also discuss the price movement for the cable and also the EU pair. First of all, from the ECB, we know that the ECB has an expected increase in the interest rate last week by 25% for September. And normally when we say there's an increase in the interest rate, it will lead to an appreciation in the currency. But this is not the case from what happened last week. So we can see that last week was like 14th of September. So when we go back to 14th September, we can see that after the ECB unexpectedly raised the interest rate, but it led to a decline in the euro value. Why is this? The main factor I would say is because we know that the euro economy is quite wobbly. It's not very healthy, and we know that some of the member states they are struggling in recovering the economy, especially now the energy cost is getting more and more expensive. So when you unexpectedly increase the interest rate, it's actually put pressure on the economy. It actually harm the economy. You actually further discourage more economic activity. That's why now people are lack of confidence in the euro economy. That's why it leads to a drop in the euro. Move back to the slide. So this is what we want to see, because last week there's a data which is the Euro CPI, shows there's a decline in the euro inflation. And also this coming Friday, they will come with this September CPI, and the market actually predicted that the inflation will go further low to 4.5%. So if this happened, if the result came 4.5 or below, you can expect the euro to go further down. But if, let's say, the CPI came higher than this number, but maybe stand unchanged to 5.2, or in between 4.5 to 5.2, I would say you no need to expect an increase for the euro. So for the EU pair, especially because we know that now the US dollar is very, very strong. And so you need a very, very strong factor to push the euro to rebound. But otherwise, I would say the euro will continue to decline, because from this trend, you can tell now the euro is trading in an extremely strong bearish momentum. And over here, you have a very solid bearish engulfing. And then after this bearish engulfing, the EU pair continue to decline. And if you look at the MACD itself and also the RSI, you can tell that the bearish momentum at the moment now is still very, very strong. So, yep, it is wise for you to continue to hold short position if you have. If not, maybe you can wait for a technical rebound if they have, and then you seize the chance and you can open a short position. And moving on, let's look at what happened in the UK. So UK is also in a conundrum where the economic in the country is not good, and also at the same time, as you can remember last week, the BOE, Bank of England, they actually decided not to increase the interest rate, and the interest rate actually leave unchanged when the market expect the BOE to continue to increase another 25 basis point. Why the situation for the UK and the Euro is different is UK has, I would say, the highest inflation rate amongst the major economy, because they now still have 6.7%, where if you can remember, the Euro have only 5.2% for CPI, and then US, they actually only have 3.7%. So in order for the UK to gradually tame the inflation, they actually needed the rate hike slowly. So the market actually expecting a 25 basis point rate hike from the BOE last week, but that's not happening because we also know at the same time, if you look at the UK GDP, you can see that the UK GDP, the economic growth is actually declining. It's not a positive, it's a negative sign, and it declined further than what's the market forecast. That's why, when the central government, the central bank is not increase the interest rate, and at the same time, the GDP is contracting. And if you can remember, the Birmingham City Council actually declared bankrupt 2 weeks ago. So adding up all these factors is actually leads to a lower table. And also, if you look at the bigger picture, you can see that the overall the cable actually traded in a 10-week losing streak, and I think the momentum will continue, and I think will at least will decline further until the next strong support level, which is at 1.193. Oh, yes. And also, if you look at the slides that I prepared today, Friday, we also have important economic data for the UK, which is the GDP. And this round also, the market predicted the GDP will turn to be better, will have a positive sign, improvising. But yeah, we don't know yet. So let's see if, let's say, the GDP come higher than the market forecast, you can expect a short-term technical rebound, but we have to wait until Friday. So yeah, by the time when Friday come, the cable might already traded to below 1.2, which is also a very, very crucial psychological support level for the cable, for the GU pair. Yes, if that's happened, that's the case when Friday come, when it touch here, and also at the same time, if you see that the GDP for UK is actually better than expected, for short-term trade, maybe you can catch a technical rebound here to maybe 1.22. If not, yeah, maybe there's another chance for you to catch a rebound at the very strong support level at here. But remember, overall, it is more wise for you to catch a short position for the cable, because we know that now the cable is trading in an extreme bearish momentum. So moving on, we will talk more about oil. Oil is more special because we know that normally when the dollar is more expensive, it will have a bad impact on the oil prices. But now this is not the case. Let's look at the oil price chart. We can see that since July, when the oil price traded to its lowest levels in years, and it started to rebound, and it rebounds strongly, and it's not stopping. And then now I would say sky's the limit, it's now breaking this resistance level. So people, initially expect that they might form a double top and then coming down, but now this is not the case, and it's breaking above this resistance level, which is very strong. So previously, why it dropped, for the last 2 weeks, why it dropped here was because people are actually uncertain with the central bank's monetary policy around the world, because we know last 2 weeks the ECB, BOE, BOJ, and the Federal Reserve, all of them are going to announce their monetary policy. And after what the Federal Reserve say in the last week, they're expecting a higher and longer interest rate policy that's going to impose by them. And the market actually have the theme for it, and then it's hindered the oil price to trade in a bigger sideway and decline slightly. But after that, you have this strong candlestick to support the oil price. Why? It's because the oil actually has a very solid fundamental. So we can look at just the supply and the demands factor for the oil price, and then you can tell in the near future, we can expect the oil price will continue to surge higher. First thing is the OPEC, the allies, the biggest cartel in the world. They actually want to extend their oil cuts until December. This means that the oil supply in the world is still, declining. And I think last week or 2 weeks ago, Russia temporarily banned the export of gasoline and also diesel to all the countries besides the ex-Soviet states, which is only 4 countries. And after they announced this, the diesel price, especially in the Eurozone, surged to the record high. And also at the same time in the US, the oil and gas rig count fell to the lowest since February 2022. So adding up all these factors, you can see that the oil supply in the world globally is declining month by month. So this is the supply side factor. And we look at the demand side, you can see that the US crude oil inventories data, which came out every week. You can see for the past 5 weeks, 4 weeks or in decline. This means that the US, because early on we say that the US economic is actually doing quite well, so they actually demand for more oil when have more economic activity. So this is one point. And also, but at the same time, the federal aggressive monetary tightening policy will also have some impact on the oil price. And we also know this coming Saturday, China will release their PMI. So if let's say the China PMI reading is above the expectation, this means that the China economy is recovering. This also equivalents that they will demand for more oil in China. And we also know China is the biggest oil importer in the world. So when they are recovering their economic, they will demand for more oil. It will also bolster the oil price to go higher. So adding up to the demand and supply factor for oil, you can actually expect the oil price to trade to the highest levels. The next resistance level, which is maybe above, maybe at 95. So if you want to have a swing trade, you can enter a long position after it firmly stay above this then resistance level and now the current support level. And the next TP you can set at $95. Lastly, we will briefly discuss the RBA, or Reserve Bank of Australia. So Australia, if you can remember, for the previous 3 times, they actually decided not to raise the interest rate in Australia. So the Australia interest rate has already stopped increasing for the past 4 months. But we also know at the same time, the RBA actually adopted a data-dependent approach when they decide the interest rate decision. If you look at the economic data for Australia, you can actually see that the GDP for Australia is getting better because previously they decided to halt their interest rate hike. So yeah, as a result, the GDP is getting better, and also at the same time, you can see at the labor market, the labor market is also improving. So there's a chance that the RBA will decide to go for a rate hike this round. If that is going to happen, it will have a positive impact on the Aussie dollar. So if you look at the Australia, and also tomorrow, tomorrow Australia will also release their retail sales. This is also a very crucial economic data for the RBA to decide whether or not they will increase the interest rate. If the number come better than 0.5 or so, you can expect the Aussie dollar to rebound, because now it come to a very crucial and also strong support level already. But in the previous a week or two, you can see also the Australian dollar is trading in a very bearish momentum. Yes. So tomorrow, when Australia release their retail sales data, it is very crucial. And again, if the number come better than expected, you can expect a rebound for the AUD USD. And then later on Monday, if the RBA decided to go for a rate hike this round, it also have a positive impact for the Aussie dollar. And in general, you can see that from in the month of September, you can see the Australian dollar is traded quite strongly if you compare to the GBP, if you compare to the euro, and also if you look at the dollar index, you see the entire September the dollar actually increased, but the Australian dollar can actually withhold with the strong US dollar. So if there's any good news for the Aussie dollar or for Australia, you can expect the Aussie dollar to rebound. So as a reminder, tomorrow we will have a crucial Australia retail sales that's coming out on tomorrow, and also on the coming Monday, also very important, we will have the RBA interest rate decision. So that's all for today's. Thank you for joining us. And we will open for Q&A session now. So if you have any questions, you can type in the chat or ask in the Q&A, and if I can able to answer you, I will do so. So if there's no questions, we shall end our sessions today. Just a reminder, we will have a very interesting topic also for next Wednesday. Welcome you guys to join us for next Wednesday at the same time.